All right, Rick, I'm a trader. I'm going to short equities. I'm going to buy the dollar maybe, and I'm going to short treasuries. Is that the right trade for this report?
So I'd say a couple of things. One, I think equity markets had a heck of a run. I think people are going to rightly interpret that the Fed can move. They're going to go in December. They're going to go, we think, 2 to 3 times next year. Do I think equities are still going to, after people digest this, do I think equities will still go higher? I do. And there's a bunch of reasons which we could talk about why I think equities are going to go higher. Rates market, we've said that we think the 10-year is going to 250, 275 this year. I felt really bashful about that about 3 weeks ago. Listen, I think people are misinterpreting. First of all, I think we throw out, the hurricane. I have a chart. I don't know if y'all can show it up there. But people have, I think you throw out some of this top line, this negative 33,000. You saw the same thing in Katrina. The wage data is real. And I think, and the unemployment rate of 4.2 is real, is a good number. The thing that I think people aren't factoring, and people say there's no wage inflation taking place. If you strip out, if you look at what the Fed wage tracker shows is 3.5% wage growth. If you take median wage growth, it's been, by BLS, it's been about 4.2%. This is confirmation that we are getting real wage growth. There's a couple of charts we have. This one is, I think, pretty interesting. This is this is over 70 years. And what you can see is the end point is the stability of the wage data over time. Save this number because of the hurricane effect. The average 12-month average of jobs is going to be about 175,000 jobs. Unbelievably consistent versus anything you've seen in history. So I think people recognize the reason why the markets are reacting, headline negative 33,000, you think rates would start to rally, they're going the other way. So people are rightly assuming, don't worry about this number. I don't know if there's a Katrina one is the last.
I love when Rick pulls up his own charts and talks. So you don't need us. We're going to take a coffee break.
I have another 150,
it's
but
Rick
they won't let me
Rieder
show them.
Through to Gary Cohn at 9:30.
Sorry.
Catch you guys Monday.
I'm done. Oh, what happened to my chart? Anyway, the one I wanted to show was the exact same thing happened, and a lot of economists forecast this in terms of this number. But that is the dip you saw in Katrina, and then you got it right back. We're going to get it right back again next month or the month after. So, the markets are rightly assuming, don't worry about negative 33,000.
So let's get to the rates here, because if you bring up MIPR, so MIPR, so you're basically looking at the market implied probability of rate hikes, right? This is today versus yesterday. If you come in the Bloomberg terminal, the green line here is today. The yellow line here is yesterday. It's really in the back end of the curve that we just saw a quick re-rating, literally, in the last 24 hours. In 2 years, we saw a move of over 7 basis points.
Yeah.
Is that justified based on this kind of number?
Totally. So I think there's a couple of things to factor in. One is you have a dynamic today where the Fed has laid out, I think, quite frankly, and I've said on this show a bunch of times, this year, the Fed has done a brilliant job of communicating in terms of what their trajectory is going to be. So the front end of the curve can follow the Fed very closely. Listen, the back end, particularly if you get wage acceleration, which we are getting, particularly we think, we talk a lot on the show about technologies keeping inflation down. But at the margin, it is accelerating a bit, particularly service inflation. So the long end of the curve, we think, can still have some more pressure on it. And the Fed has been pretty well in terms of articulated where they're going to be. That normally under this dynamic curve would flatten, but the curve flattened a tremendous amount over the last couple of years. That we think you could see more pressure on the back from here.